Hi, and welcome to the Stock Spinoff Investing Podcast. This is actually the first podcast, and I am delighted to have my friend Asif Suria on to join me to talk about a couple upcoming spinoffs from Inside Arbitrage. So, Asif, welcome to the podcast.
Thank you, Rich. As I was just mentioning, I'm honored to be the first guest on your podcast. Looking forward to
Yeah,
this.
I'm really excited about it. I've been wanting to do a podcast for a while, and when I first had the idea, I knew that I wanted to talk to you. So I'm delighted that you said yes. And before we get started, I do want to mention that we are going to be talking about securities. This is all for informational purposes only. And Asif and I may have positions in some of the securities that we are talking about. So this is just for informational purposes only. And with that out of the way, I would love to hear a little bit about your background, Asif. I know a decent bit about your background because we've been friends for a number of years, but I would like to get a refresher, and I'm sure it'd be helpful for everybody listening to the podcast.
Sure. I'll start from where I am most recently, where a few months ago I ended up writing a book that came out this year. It's called The Event-Driven Edge in Investing. I don't know if it shows up properly.
Yeah, that's showing up. Yep.
And so I started my technology career right before the dot-com bubble burst. I was one of the people who was trying to fix the Y2K bug, if you would. There was a university system that went down because of the Y2K bug, and every night I would fix a portion of the system so that the university could use it the next day. So that was an interesting way to get into technology. And then I ended up writing an enterprise level system for them, basically early SaaS, if you will. As part of that, I got a hands-on experience with running clusters of servers on the hardware side as well as building a large-scale software. So did that for a number of industries over 2 decades, retail, healthcare, so on and so forth. But my passion, what I would do at night and what would really drive me is investing. And so I started out investing at the worst possible time, if you will. It was after the dot-com bubble had burst. The market had dropped a lot. And I figured, things were going to come back and we were going to see, things like Priceline.com, which is booking now, rebound. And it did eventually happen, but first I had to suffer through almost 2 more years of a bear market. And so that was a great learning experience. It gave me time to, read Benjamin Graham, Phil Fisher, so on and so forth. So started out as a value investor, did that for about 8 or 9 years. And then we all ran into 2007, 2009, the Great Recession and the very deep bear market made every investor question exactly what they were doing, including me. And so that's where I started getting into event-driven investing. There was a hedge fund that introduced me to merger arbitrage. So I started looking at that. And I was also fascinated by insider transactions, which isn't, typically under the event-driven umbrella, but, just looking at management teams buy their own stock with their own money, even after being given so many options or RSUs was fascinating for me. So started doing that. I had 2 different websites that I was managing. And I think about 7, 8 years ago, I brought them together as Inside Arbitrage. So first we started out with 2 strategies, merge arbitrage and insider transactions. And then we expanded to 6, including spin-offs, stock buybacks, SPACs, and management changes.
That's great. Yeah, it's fun. It's fun to hear the background because I don't know all this. Like I didn't know that at some point the websites were different before you brought it all together. Um, One of the reasons why I'm really excited to talk to you today too is just because you have that technology background, and we are going to talk about Western Digital. So it's just interesting to hear somebody who's an expert opine on stocks that are going through spinoff situations. Because the problem with being focused on spinoffs for me is that I'm a generalist, and so it can be an interesting setup from an event-driven perspective or from like a special situations perspective. But I'm always a generalist in the industries that I'm looking at, almost by definition. And so you can just get blown up, right? If you don't know if you don't know the industry super well. So that's really fun. Um, and then so I know you do follow spinoffs, and I know you also do merger arbitrage and insider trading, but you do follow spinoffs. How do you typically, view spinoffs? Is, I guess how do you kind of typically invest in spinoffs? I know we're going to talk about two upcoming spinoffs that you like them both, but I'd love to just get a sense of how you think about investing in spinoffs.
Yeah, for me, spin-offs are more opportunistic, if you will, Rich. I know you look at every spin-off. I don't necessarily. For me, it is because maybe there was an insider transaction. And GE is a good example of that. Larry Culp was buying stock on the open market. And that was about 2 years into his tenure as a CEO of GE. And he came over from Danaher, where he did an amazing job over the prior decade. So that made me take a closer look at GE. They had already completed two spin-offs at that point, GE Transportation and GE Healthcare. And so I was very interested in GE, mostly because of the insider transaction. And then they announced a spin-off of GE Energy, which became Vernova. And so I modeled both companies, GE, the parent, and the spin-off. And I found the parent to be more attractive, but I didn't want to wait until after the spin-off. So in that case, I ended up buying GE before the spin-off happened. And once the spin-off took place, I was actually going to sell GE Vernova. But all the demand on the utility side of things, energy because of data centers, that spin-off just took off like a rocket. It's almost up 100% from when the spin-off happened. And I figured I was going to stick around with that. There were other times when I've looked at spin-offs. For example, you spoke about Western Digital. I happened to come across it more because a subscriber had a question about two spin-offs. One was an oil pipeline spin-off that happened recently, South Bow Energy, and then Western Digital. And so that made me take a closer look at that Western Digital. There were times where, for example, I used to own the stock of Jefferies, and they spun off Vitesse Energy. And I didn't find that very interesting up front. And so I ended up actually selling the little stake in Vitesse Energy I had. But I happened to go to a conference in Dallas last year, and I spoke to the management team there, watched their presentation, and that gave me better insight into what opportunity Vitesse presented. And so I ended up investing in the stock a few months after that presentation. Almost a 10% dividend yield. It generated another 15% in returns, so total returns of almost 25%. I heard them speak again this August in Chicago, and I realized that going forward, it is more of an income play, which is not what I was interested in. So in the case of Vitesse Energy, it was being at an investor conference, listening to them. So that's why I mean, things are opportunistic for me. It might come from many different directions. And I take a look at a spin-off because of an event, either a merger, an insider transaction, hearing management speak, or somebody's asking me a question about a specific spin-off.
That makes complete sense. Yeah. So you're rubbing salt in my wounds because I missed GE and I also missed GE Vernova. So I looked at GE Vernova and it came out and it was trading at, I think like 12 times EBITDA or something like that. And like in a much higher free cash flow multiple. And I thought, it's a cyclical business. It doesn't look that interesting. But what I totally missed is that this is kind of the other side of the capital cycle where nobody's really invested in GE Vernova's products and no competitors have really come online. And there's suddenly this huge, massive demand for power generation assets, which GE Vernova is like one of the leaders in. And so that stock has just been unbelievable. So congrats on that one. And that's kind of an area of the market where I've become more interested in. I call it demerger arbitrage. And I'm not the first one who said that, but the whole idea is a lot of people focus on merger arbitrage where you announce that a company's getting acquired at $100 and maybe it trades at $95 or close to that until that spread gets a little bit smaller as you get closer to the acquisition date. But because you have to do the work yourself with spinoffs, I found that if you just do the analysis yourself, and I think we're going to talk about that with Lionsgate and also with Western Digital, sometimes you can get to the case where there's really good upside, and all you have to do is basically hold it through the demerger or hold it through the spinoff. So really interesting perspective there. Let's get into one of the names that I know you like, Lionsgate. So I'd love for you to just kind of walk through why you think Lionsgate is interesting, kind of high level thesis for, why you're recommending Lionsgate at this point.
Yeah, so Lionsgate has had a fascinating history. It's been a roller coaster ride for investors. If you look at a 20-year chart of Lionsgate, they've not made any money over a 20-year period.
Wow.
It's a phenomenal failure of the CEO, who's been at the helm since 2000. So you've had many situations with this company that is behind, very popular franchises such as Mad Men on TV shows, or Hunger Games, the movies, or the horror franchise Saw. They come up at, Saw 15, Saw 25, Saw 50. I don't know. It just keeps going on and on. But they're excellent at making money on these low budget productions, if you will. So they have a wonderful library of well-recognized names like John Wick and Hunger Games. And at the same time, they're able to do, low budget things that turn a good ROI for the company. And then they have sleeper hits. That was 310 from Yuma, a Western, a long time ago. There's La La Land. So they end up with these sleeper hits that energizes a stock for a few months, and then it comes right back down again. So the library that Lionsgate owns is very valuable. You have a situation where Netflix, Disney, Apple TV, Amazon Prime, they're all competing for viewer eyeballs. And content is what drives these platforms, and there's only so much new content you keep producing, and it's expensive to do that, and it's hit or miss. So Amazon went and spent about $8.5 billion to buy MGM. They wanted that library, and all of us feel that Lionsgate is going to be the next acquisition target because of its streaming library. What's happened with the company over the years is Carl Icahn got interested in the company. He made a low ball bid for the company in 2010 for $6 a share. He bumped it up to $7 a share. And Mark Rachesky, who had worked with Carl Icahn, ended up buying a bunch of Lionsgate stock, ended up on the board of directors as well. And he's been there for a long time. So he was kind of like an activist investor that was involved. And many of us who were invested in the company felt that he's going to try to make the management team see that they need to do something with these very valuable assets. But that hasn't quite played out as we expected. On the other hand, you had a few years ago, I think 2017, 2018, Hasbro came along and they wanted to buy the company for $5 billion. I think it worked out to something like $35 a share. I don't remember the exact number, but the management team turned that down as well. So this is a company, just this upfront disclaimer, that has disappointed investors for a really long time. So why now? What's different now? So what's happening now is, a few years ago, they decided to, in their infinite wisdom, go and buy Stars. Almost everybody realized cable cutting was, cord cutting was going on. Cable TV viewership was going down. Yet Lionsgate spent, I think, $4.4 billion buying Stars. And so they had the situation where they, as you mentioned, did this big merger, which didn't quite work out for them. And now finally, they're at a point where they said, we're going to spin out the Stars division. And that's been going back and forth for almost a couple of years at this point. Finally, they decided to IPO a part of the company. But unlike what many of us were expecting, where they would spin off Stars, they instead decided to IPO the studios portion of the company, which has a valuable movie and TV streaming library. And that library generated almost $1 billion in the streaming revenue. So when you look at it, the revenue it has generated, the titles it has, and they also did a small tuck-in acquisition of E1 from Canada that increased their size of the library. It's a very valuable asset. And so the IPO of Lionsgate Studios, which now has a symbol Lion, Lion, was an interesting event, which is what got me interested in the stock again. I'd invested in it, I think, in 2007 or 2008, way back when. And now with this situation going on the last couple of years, I've been very interested in the company. Yeah.
That's really interesting. Yeah. So what was the thesis for Hasbro buying? Why did Hasbro want to buy? Did they want to get, did they sell a bunch of toys or action figures related to some of the studio hits? Or I'm just curious, do you recall why Hasbro was interested in Lionsgate at one point?
I don't recall why. Maybe they had a licensing deal where Lionsgate had licenses for some of their, heroes, if you will, or toys or something like that. But I don't recall exactly what made them want to buy Lionsgate. It was an unusual acquisition bid, but yeah, it didn't quite work out.
It's so interesting because you have these, yeah, random. That would have been such a great move for Lionsgate to just basically sell for that valuation. Um, w- One thing, so I've done some work on Lionsgate, and yeah, I mean, I think that the high level reason why I agree with you that it's really interesting is, and this math is a little bit old, so we're speaking on October 21st, 2024. This is when the stock was a little bit higher, but I think LGF, which is Lionsgate, um, the parent company that is going to be spinning off Lionsgate Studios, ticker LION. Last time I looked at it, it was trading at like a 2 billion market cap, and then it's 87% stake. So it basically took Lionsgate Studio through a SPAC transaction where it went public. Um, and I think it sold only about maybe 13% of Lionsgate Studios. And so the parent company still owns 87% of the spinoff. And if you value it at the time, it was trading at a valuation of like 1.9 billion. And if you speaking to precedent transactions, historically these studios are sold at 15, 16 times EBITDA or higher. And so if you valued the studio, the spinoff at like 16 times EBITDA, it would be worth, 11 or $12 per Lionsgate parent company share. And so Lionsgate parent company at the time was trading, at 8.50. I think it's even below $8 right now. And then after the spinoff takes place, you're going to own the Stars business, which isn't a great business, but I think management thinks that it's going to generate about 200 million of EBITDA, and I think there's going to be like, 2 or 3 turns of debt. So, by my math, that could be worth another dollar or two. And so, at a high level, it could be an interesting demerger arbitrage situation where you're buying the company right now, the parent, for maybe 750 or $8, and then essentially you're getting 13 or $14 of value down the road. So I totally agree that it's super interesting. And I guess the other angle is that there's been insider buying. Has there still been insider buying recently? Because I know there was some good insider buying at least over the summer, like in August, I think.
Yeah, so I can touch on the insider buying side of it, but first I wanted to mention I'm glad you said that it went public by merging into a SPAC. So it wasn't a traditional IPO; it was a SPAC merger with Screaming Eagle. And there was a little bit of an opportunity there where there were Screaming Eagle warrants that were outstanding that they were going to buy back, and you could very low volume, but you could make about 9-10% if that worked out, and it actually did. So the CEO of Screaming Eagle, the SPAC, is a industry insider, well respected, and so in that sense, it also made sense that they wanted to do this transaction. And the CEO of Lionsgate, along with Mark Lachesky, are going to move over to Lionsgate Studios instead of staying with the parent Lionsgate Entertainment, which retains Stars. So a whole lot of interesting stuff going on there. But the most interesting situation right now is the insider buying you mentioned. So a former U.S. Secretary Treasury, Steven Mnuchin, has ended up a Treasury Secretary, not the Secretary. He ended up buying a bunch of stock of Lionsgate Entertainment, and so he's been continuously buying, including last week. He's been buying Lionsgate Class A shares, which have voting privileges. So that's what he started with. And now he's expanded to buying Lionsgate Class B shares as well, which don't have voting rights. There is a proposal to collapse both classes of shares and just make it Lionsgate Entertainment. So you won't have Class A and Class B going forward. So maybe he just wants to get enough control of the company to agitate for change. And I think he's the right person to do this because clearly there's a lot of value to be unlocked. This SPAC merger and hopefully the potential spin-off down the road could do that. But having somebody like Steven Mnuchin involved, I think, is going to help accelerate that value realization.
And does he have you said, I mean, you're expert in tracking insiders. He has a pretty good track record in terms of good performance. Is that right?
He does. So he got involved with some distressed banks way back in 2008, 2009. He was also somebody who came in with a package for NYCB when they ran into their issues earlier this year. So he has a track record of getting involved with distressed, especially banks. And in some sense, I see this Lionsgate situation as being distressed as well. As I mentioned, the stock has gone nowhere for 20 years. This management team really needs an activist to get involved.
Got it. And then, yeah, the other interesting thing is it's a situation where if you, I mean, Lionsgate, it IPO'd, or it went public via SPAC. It has a low float. So it just seems like it's a ripe situation, for once this upcoming spinoff happens, that it could be ripe for a re-rating. And even if the acquisition doesn't materialize, the potential for one or rumors could send the stock flying. I think, as I recall, I think there are three caveats or three things that need to take place before the spinoff can occur. And I need to touch base with the company to see the status update on all of these. My understanding is the A and B shares need to be collapsed. I think the current proposal is that the A shares will get 12% more value than the B shares. And I think the A shares are trading at about a 12% premium to the A shares. So it seems like the market thinks that that's going to take place. The spinoff needs to be approved, which, there's clear value here. So I don't see why shareholders wouldn't do that. And then the debt needs to be, I think some debt needs to be refinanced. And I've seen I haven't dug too deeply into it, but I've seen that there have been some lawsuits about refinancing the debt. So maybe perhaps that is the one thing that really needs to get solved before the spinoff can take place. Do you have any thoughts on whether I guess on like how likely, it seems like they've been working for a very long time to make the spinoff happen. It seems like that's the key catalyst. I guess how much confidence that you have that the spinoff actually will take place?
Fairly confident. I think the Canadian pension plan lawsuit related to the debt refinancing might get resolved. I'm not that concerned about that situation. Steven Mnuchin is a wild card. I don't know how he's going to act once he's got enough ownership of Lionsgate Entertainment. He's not buying Lionsgate Studios stock, Lion. The float is low. I understand that it would be very difficult for him to start buying that in size. And that's why he started with Class A shares and then Class B shares. But I have no idea how he might react and what he might vote for. And considering he's building up a stake and buying almost every week or every other week, that remains a wild card, and it's hard to predict how that will play out.
That's really interesting. I didn't realize that he's buying. Yeah, he continues to buy. Do you know how much he owns in total so far?
I don't know for sure. I think the last time I checked, it was probably close to 15%, but I'll have to check on that.
Yeah, that's a big position. That's a big position. Okay, interesting. And then how do you think about kind of risks to this story? So I know they had like a big movie, Borderline, which has been underwhelming. I think it's been a little bit of a bust. I've read some headlines that Lionsgate Studio has kind of had a couple busts of late. It seems like they have a great lineup of movies coming out next year. I think there's like Saw, whatever we're at, Saw 15 or Saw 16 or wherever we are. I think another Hunger Games is coming out. I think there's going to be a good lineup coming out next year, but it seems like this year the movies have kind of disappointed. I'm curious what you think of in terms of like the risks for the Lionsgate story at this point.
Yeah, so as you mentioned, the studios is driven a little bit by hits and misses, and there are some years when you get a great number of sequels of popular franchises. I think a year or two ago, there was John Wick and New Hunger Games that drove studio profits. So you're going to see that ups and downs, the ebbs and flows, and so a little bit of a cyclical business in that sense, a little bit driven by hits. But every once in a while they end up with a sleeper hit that then launches a whole new franchise of movies that they can capitalize on. But really, at the end of the day, the value is the library, and the streaming business from the library has been growing over time. It was 750 million about 2-3 years ago. It's close to a billion or over a billion at this point. So that's where I see the value, not necessarily which movie is coming out next year or the year after that.
And it's very high margin revenue. That streaming revenue, right, is basically like a royalty. So it's extremely high margin. Okay. And it's growing. Okay. So it's 750 or so last year. It's up to a billion. And theoretically will continue to grow going forward.
Yeah, and so that's where the management team wants to be with the Lionsgate Studios side of the business. It's the more exciting business, the better margin business, so on and so forth. In terms of risk, I do see execution risk. As I mentioned, for 20 years, nothing has happened to the stock. Everybody sees the value. But as you and I know, some of the part situations or underlying value can take a really long time to get realized, and you need a catalyst. And in this case, this merger with the SPAC and potential spin-off is the likely catalyst, as long as the wild card of Steven Mnuchin doesn't work in the opposite direction of what we're expecting.
Got it. That's super helpful, Asif. I love that background. Okay, so let's move on to another name that I like as well, and I was really excited to see. I get your newsletter, and I saw that you recommended as one of your ideas very recently, and so was excited to talk about Western Digital. And I'm especially excited to talk about it because again, you have that tech background. So like I might talk about hard drives and flash and all that stuff and read industry commentary and sell side reports, but at the end of the day, I don't really have great insights into how those products are actually used in the real world. And so I'm very excited to talk to you about Western Digital. So talk to me about the Western Digital investment case. You know, how did you come across it? You know, why do you think it's interesting?
Yeah, Western Digital is a fascinating company. Just like Lionsgate, this was something I'd invested in maybe 15, 16 years ago. So very familiar with the company. As I mentioned, I used to manage a cluster of servers. And obviously back then, flash drives didn't exist. We used to have multiple hard drives for redundancy in case there was a failure of one hard drive. And then you used to have to back up those servers before network attached storage showed up or the cloud showed up, and you could start using these data centers. We used to back these servers up on what I call magnetic tapes. So you had this little device on the side, we put a cartridge in there, and each of these magnetic tape cartridges were about 40 gigabytes in size. And we would partner with maybe another department or another company, and we would rotate those tapes. So in case the building burned down or got flooded or something, at least one of your backups was someplace else. And then there were companies that would do that. They would stop by, they'll pick up your magnetic tapes and keep them in a secure off-site location. So, back then 40 GB seemed like a lot of space. And I was talking to a friend recently who works in Google Cloud, and he said, we still use magnetic tapes for deep storage. And I was just shocked to hear that. I thought magnetic tapes, which came out in maybe the 1960s or 70s, would pretty much go the way of the dodo bird. But that hasn't quite happened. And the new tapes, each cartridge is almost 18 terabytes in size. So massive storage capabilities. And the reason the magnetic tapes exist is because the cost of storage is low and they are highly durable. So if you wanted something to last for a really long time, you would put it on a magnetic tape and store it. And what happened with hard drives is when flash drives came along, everybody felt like that was the end of the hard drives. Over time, the flash drives were expected to be able to hold greater amounts of data. And also, as things scale, we expected the price of flash drives to come down. They had significant advantages. So for example, with hard drives, there are these moving plateaus. And so if you were to drop a hard drive, there's a good chance it would fail. But now nobody thinks twice about their phone dropping. And the biggest concern might be maybe the screen cracks, but nobody's concerned about the data inside the phone because these flash drives are very durable in that sense in terms of movement and so on and so forth. But they do have limited life. There's only so many writes you can do to a flash drive. And the failure rates in terms of durability over a long period of time are higher than hard drives. So you have this interesting situation where 4 or 5 years ago, maybe even earlier than that, people felt like hard drives are not going to be there for much longer and flash drives was the future. And Western Digital ended up paying $19 billion to buy the flash drive company SanDisk. Fast forward to today, and what we're realizing is the gap in price between hard drives and flash drives hasn't quite closed as much as people expected. You're still paying 4 to 5 times as much for a flash drive as you would have done for a hard drive. So what's happened is you see a situation where hard drives are not only still in use, but usage is growing because data is growing. And because of AI and because of the internet and large amounts of data being created every minute, every second, hard drives seem to be firmly in place as a low-cost alternative to data storage that isn't needed immediately, if you will. So both Western Digital and Seagate have seen their hard drive business continue to grow. In contrast, on the flash side of the business, that is a highly cyclical industry. So you have this situation where demand suddenly increases and there's limited supply and flash drive prices go up. And just like with any cyclical industry, more production comes on and you start seeing that supply outstrips demand and prices go down. So Western Digital had this situation where not only did their core business start to decline, but they started seeing profitability issues from this highly cyclical business. So last year, and as they were reaching this point where the cyclical side of the flash business was not doing well, they decided to finally spin off the flash drive business, if you will.
Got it. And so two quick questions for you. So I guess comparing hard drives to flash, is flash more durable than hard drives or less durable?
In the long run, it's less durable because there are a limited number of writes and they don't last as long as hard drives. But when you look at it in terms of the fact that they're more durable right here, right now, because they are able to take greater abuse, if you will, from people moving things around and so on and so forth.
Got it. Okay.
So hard drives on a desktop computer, hard drives in data centers are just fine. But hard drives on a laptop, which sees more movement, and obviously it can't be on a phone. So it really is device dependent in terms of which one you would prefer, the hard drive versus a flash drive.
And then the hard drive industry has been less cyclical, you would say, than the flash industry?
Yeah, in the US, it's almost a duopoly. You have Western Digital and you have Seagate. You might have some HP drives that are actually rebranded drives, then HP doesn't make them. And then out of Japan, you have Toshiba. So you have really just a few producers of these hard drives, and the growth has been slow but steady, right? So you continue to see linear growth. It's not exponential growth. So yeah, that business has not been quite as cyclical as a flash business.
That's really, really, really interesting. And then how would you compare Seagate's hard drive business to Western Digital's? How do you compare one against the other? Because I know, at least I think both of us, I mean, it's a duopoly market. So if you're trying to do some of the parts analysis, obviously you're going to compare Western Digital's hard drive business to Seagate. So like when you look at those two businesses, how do they compare?
So way back when Seagate had a better perception among consumers, it was considered the higher quality hard drive. And you went to Western Digital if you wanted a slightly lower priced hard drive. That perceived difference in quality no longer exists. So people would just as happily buy a Western Digital hard drive as they would buy a Seagate. In terms of profitability, I think Western Digital's hard drive business might be just a touch more profitable than Seagate. I have to go back and check the numbers. But in most other cases, when you look at how both divisions are doing, they're actually quite similar. So there isn't a whole lot of difference. Seagate makes for a very good competitive peer to look at in terms of what Western Digital's standalone hard drive business might look like going forward.
It's interesting because I read Elliott's letter, which came out. So Elliott Management, when activists, bought about $1 billion of Western Digital stock and urged the spinoff. So that was over 2 years ago. And that's a great letter to just understand the background and the history of why the initial SanDisk acquisition was made and how it basically was a colossal failure and how they need to just separate the businesses right now. And they also made the point that Seagate has gained market share versus Western Digital on the hard drive side. This was as of 2 years ago, but I was reading some transcripts recently for Western Digital, and it seems to me that Western Digital has actually higher market share now. So it seems like they've actually recovered, and their gross margins are now at, I think, at an all-time high. And so, yeah, it's Elliott made the case that basically Seagate is kind of like an aspirational peer. They've passed Western Digital on the hard drive side, but it seems like Western Digital has kind of caught up in the past couple of years. Would you agree? Is that fair?
Absolutely. They've caught up in the last couple of years. And as you mentioned in your research note, it used to be that the flash business was generating more revenue. It's just a little bit more than the hard drive business for Western Digital. But I think as of last quarter, that's flipped. the hard drive division is generating more revenue than the flash business for Western Digital.
Got it. And then let's think. So let's talk about, the valuation. So it seems like this is a pretty clear demerger arbitrage situation. You have a clear comp in Seagate for the hard drive business of Western Digital. How do you think of the valuation of these two assets and, how much value potentially could be unlocked if the spinoff actually takes place?
Yeah, so at this point, Western Digital is trading at almost half the valuation of Seagate. When you look at, PE or EV/EBITDA or price per sales, depending on which metric you look at, they're trading at a significant discount to Seagate. So once you end up with this flash division being separated, I think you'll see that valuation gap close between them. Western Digital actually has a little bit more debt, maybe $1 billion more. But I'm sure they'll load the flash division up with some of that debt. So Western Digital standalone will have a lower, obviously, enterprise value and probably lower debt compared to Seagate going forward. What's interesting at the end of the day at this point for me is not just the valuation gap, it's also the fact that we're seeing a rebound in flash. So last year was a cyclical down period for flash, and now we're starting to see an increase in demand, an increase in prices. So flash is coming back, and at the same time, demand for hard drives because of data centers has increased quite a bit. So you have two parts of the businesses, or two parts of their business suddenly starting to accelerate. And so this spin-off, if it happens, say in Q4, which is what they're guiding for, would be an excellent time to realize that value. Because for the next few quarters after that, I think you're going to continue to see some revenue acceleration. Because of increased demand from AI models being trained on vast amounts of data.
I'm really glad you brought that up because I cover spinoffs, and a lot of times it's a good company spinning off a bad company. So it's a good co, bad co situation, or sometimes the good co is spun off, but usually it's a good co, bad co situation here. And I don't know if there is a good co or bad co setup here, but oftentimes there is a valuation unlock that is expected to take place, or it looks like it'll take place. But oftentimes a good co will be spinning off a bad co that is in secular decline and has horrible fundamentals. So you're just looking at these companies with like bad fundamentals, tons of debt, cyclical businesses, and not to say that flash isn't cyclical. But the thing that I find really interesting about this is that both businesses are inflecting higher. So I think 2023 was the worst. I listened to the New Era of NAND. It was a webinar that Western Digital put on, and they said that 2023 was the worst period in terms of operating profit or operating losses in the history of the flash NAND industry. And so the nice thing that I see is it does look pretty clear from a valuation perspective that you're going to see a valuation unlock just if you were to value the hard drive business similar to Seagate from like an EV to revenue or an EV to EBITDA or whatever way you wanted to do that. But the nice thing too is it seems like both businesses are inflecting higher, right? They're coming out of cyclical troughs and they're inflecting higher. Margins are heading in the right direction. So that's something that I don't get to see very often, but it usually sets up to be a really good situation when there's the special situation angle with fundamentals inflecting the right way. Talk to me a little bit about AI. So do you think AI is going to be a benefit for both the hard drive and the flash business? Is it going to benefit one, more than the other? I'd love to hear your perspective on that.
So, you're right. When I look at this Western Digital situation, it reminds me of GE before the Vernova spin-off. And that's why I ended up buying Western Digital before the spin-off. I want to own both parts of the business. And because of the separation, I think the value unlock is going to happen. And then this isn't a hold forever kind of situation. Eventually the flash business will once again run into the cyclical issues that it usually does. But I think in the next 6 months, I find it to be an attractive way to capture the unlock that is likely to happen. I love the fact that you brought up this situation of the good co, bad co. I participated in some of those. There was a retail REIT called DDR. I think you might remember them. It's called Site Centers now. Also had
Yes.
a very recent spin-off that you wrote about once again. So back when DDR was spinning off part of its company, they had this division that was operating in Puerto Rico. They had a set of malls there, and Puerto Rico had been hit by a hurricane and was doing quite badly. That at that point in time, the whole island was in trouble. And so what DDR did was it took its Puerto Rico assets along with a few underperforming US assets and spun that off into essentially what you call the bad co. And so I ended up buying the parent company after the spinoff, thinking, hey, you end up with this company that has the best assets with less debt, and it's likely to do well coming out of the COVID-19 rebound in retail REITs. And that didn't quite play out as I had hoped for. Which is why it was interesting to see your write up on yet another spinoff that this company was doing. And just because of my experience with it, which didn't quite work out for me, I didn't end up participating in this new spinoff, which could be a mistake. So you're right. A lot of time you see the good co, bad co situation, and you have to look at both the spinoff and the parent to figure out should you be buying the parent or the spinoff. But in this case, I think it's good co and better co is how I would classify the Western digital situation.
And then what about AI? Do you think AI will benefit both the flash business and the hard drive business, or more one than the other?
I think it'll benefit both. So flash retrieval is very fast compared to hard drives, right? So that's an advantage that flash has. So when you're looking at read write, where it needs to be high availability, flash makes a lot of sense. But you also have, storage like Amazon's Glacier storage. So if you don't need the data accessible immediately, you want to put it on a cheap storage thing, you would move to Glacier. So something like that, which doesn't need to be accessed all the time, or it's a process that's not, interacting with a user, you could put it on a hard drive. So as you know, Rich, we collect a lot of data on all the strategies. We are constantly collecting data from Edgar. And so when we get data from the SEC, sometimes we're doing it every few seconds, every few minutes. But there are processes we run every night, a fail-safe process in case we missed a Form 4 filing of an insider transaction. The fail-safe process then goes and checks and sees what it missed, and it goes and picks that up. So that's a process that's not interacting with anybody on the InsideArbitrage website. It doesn't need an immediate response, if you will. So there are processes that are deep storage that benefit hard drives. And I would think of it the way you look at AI models at this point. When you want to train your AI model, you want the fastest NVIDIA chips that you can find for that model. But when you come to the part where you're asking questions of ChatGPT, Claude Sonnet, or any one of these models, that is called inference. So it's just asking questions against some pre-trained model. And so something like that can run on a GPU or a CPU that is not quite as powerful as the ones you use to train the AI model. So you can think of this in a similar fashion, where the flash is needed in situations where you need a fast response, and the hard drives have a role to play for deep storage as well as for processes that again take their time.
Got it. Yeah, that makes complete sense. As I understand it, just as you described it, if you need to back up photos that you're only going to look at like once a year, hard drive will be a good application to do that. But if you need something, very quick, you're going to want to use flash. So Asif, this has been incredibly helpful, really helpful for me. Hopefully it's helpful for everybody else. I know it will be. Where can people find more about InsideArbitrage? And if they have any more questions for you or want to sign up for the newsletter, where can they do that?
Yeah, you can find me on InsideArbitrage.com. We publish on a very regular schedule, multiple times a week. You can also find me on Twitter at Asif Suria, as well as LinkedIn. So you can reach out to me at any of those channels. I'm usually quite responsive.
Awesome. Well, Asif, great to chat. Thanks for taking some time, and I'm sure we will speak soon.